A little while ago, I caught up with Pankaj Vaish, the head markets and security services at Citi South Asia. I began by asking him whether the return of FII flows into emerging markets and India is likely to continue going forward. Let's hear out a chunk of that conversation.
The global backdrop, you are correct, that the fact that the Federal Reserve in September could not hike, and if you want, we can talk about that a little bit more. That has given a bit of a all clear, and then when you had the non-farm payroll report, I think it looked to a lot of market participants that the Fed may not be able to go for many, many months. And so people who, and actually we didn't notice it so much in India, but if you look at Brazil, where government bond yields were going in double digits and the currency had gone to 4.25, which used to be below 2 just a couple of years ago. So when you start getting those kind of values, I think people felt at least a bit brave that they could step in again. It's been quite a bloodbath in emerging markets this year. I think in India we've been fairly lucky that we haven't experienced a big chunk of it. But most EMs have had a very bad time, including some in Asia. So I think this gave a little bit of a comfort to market participants. But India will definitely be a beneficiary of it, and India is clearly among the best of all EMs. But I think these hedge funds are being quite careful in terms of picking apart which country they want to get into. So there's still serious issues with South Africa, with Russia, even China, of course. So they're being quite picky about which EM to get into, but India clearly is among the best, and so we will be beneficiaries of that.
We got Chinese GDP numbers, came in at 6.9 versus the polls of 6.8. Even the quarter-on-quarter numbers are better at 1.8 versus expectations of 1.7. So is it that China is not going to be the big negative force it has been year to date?
So I think our view at Citi for quite some time has been that China is quite weak. We think actually the real numbers may be far lower than this. We had our offsite in Shanghai at the end of July, and when I came back from that, I mentioned it in an interview also, that some of our friends over there are thinking that the real GDP growth may be in fact below 5%. Now the thing in China is you can pretty much get the number you want, so you have to be a bit careful with it. Given that the Federal Reserve in September kind of ended up mentioning China so many times in the press conference, I think more than they wanted to. But now that the market community believes that they've tied themselves to China, watching China has become very important. Even the import number that came last week was discussed to death in terms of is the INR component okay or not. So I think we are watching it maybe a bit too closely. The reality is there is a clear deceleration in China. Whether it comes a tenth better or 2/10 better than people's expectation is not important. They've done something quite messy on the currency front, which net people have not been able to figure out what it achieves. They say they're trying to become a lot more open market oriented. If you believe that, that's fine. I think that's okay. We can give them that benefit of the doubt. But then what they did on the CNH and bringing it below CNY, it's led to a lot of confusion, not the confusion that a major superpower, economic superpower, should be propagating in the marketplace. So our own view is that the domestic economy actually is fairly weak. They are trying to orient more towards the services sector, away from manufacturing. That transformation is not easy. In a command economy, still it can be a bit easier, but still is never easy. And the asset situation, the debt situation is actually still extremely problematic. So we're still very concerned about Chinese growth. You can still always have 1 or 2 quarters of better than expected because people have ratcheted down their expectations. But we are concerned about the Chinese market.
All right, then, and you can watch this entire conversation at 6:30 p.m. only on CNBC TV 18.